Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the trading recap video where we go over all of the trades that we made here today. It's Monday, February 3rd, and we had one heck of a day in the stock market. It was probably one of the more volatile days we've had in the last 6 months. Stocks were down big time, bonds were up big time, pretty much everything on the table, really except for Twitter that ended higher, ironically enough, was down on the day. But that also gives us a big opportunity to make some new trades and take some trades off that we had been hoping for, downside moves in the market. So I want to go over those tonight. But before I do, I wanted to give you guys a quick peek of what I just finished up on the membership side of the website, and that's the Ultimate Strategy Guide. And I've been working on this for a little bit now, but again, I wanted something because I get so many emails from viewers and members. Kirk, I don't understand. What do I trade? What strategy do I trade? How do I figure out what strategy to trade? And I put this together with a lot of thought, and it's laid out exactly as you guys need it. With only answering 3 quick questions, you can find out exactly which strategy you can trade. And then I have a guide about how to implement that strategy. So I want to give you a quick highlight. I'll be doing a huge video tutorial about it that I'll be posting online publicly. But again, just a quick sneak peek. You can access this right in the membership area right now. But again, you just pick your direction, you pick your implied volatility level, and that's what I always preach in the videos, and then you choose a strategy. So down below, we have this quick, really nice layout where you pick A, the direction. Are you bullish? Down below is, are you neutral on the strategy, or are you bearish on the underlying stock? And then next to that, you pick IV rank. So is implied volatility above the 50th percentile or below the 50th percentile? And depending on where it is, then you choose your strategy, whatever fits for that particular instance. So in this case, if you're bullish on the market and implied volatility is high, then you might go after a put credit spread. And down below here, you'll see that I have an example. We talk about risk reward, implied volatility, time erosion, break-even points, etc. And so this is all here right inside the membership area for you to access anytime you want. Now again, I'll be going over this with a huge video tutorial, but for now, hopefully that gets your attention grabbed and you guys go in there and check it out and start playing around with it. I think you'll really love it. All right, so let's talk about the trades that we made here today. We had a lot of opening trades. Again, huge opportunity to trade this market with high implied volatility. But we also had some closing trades. So I want to go over those closing trades first before I go over the opening trades. Now, again, this video is going to be a little bit longer because we had so many trades, but stick with me. I'll go over every single trade in detail. So the first one that we closed out was actually the vertical call spread, which was part of an iron condor on DIA. So we had originally traded a very nice iron condor on the diamonds, which is DIA. And right now, since the market has fallen, we bought back the 165, 167 call spread side of that trade. So we took in a nice profit of $34 on this, and that leaves open the other put side of the trade. And really all it gets down to here, folks, is that the market has gone down, so DIA continues to move lower, and we took profits on that call side. The 165, 167 was really way far out of the market now, so it had basically gotten all of its premium decayed. We took that strategy off, and now we're going to look for this market to bounce back up and then take profits on the other side of the trade. The other trade that we closed out here today was MA or MasterCard. We bought back the vertical call spread that we had in MasterCard, the 81.82 call spread, bought it back for a 12-cent debit. So a nice $20 profit per spread that we sold. So again, we sold 6 verticals, $20 per vertical. Same thing here with MasterCard, really no change. MasterCard continues to move lower even after earnings. And with it moving lower, we bought back the call spread that we had above the market. As the market gives you an opportunity to take profits off the table, like we continue to preach, you get an opportunity to take 50 to 75% of your max potential profit on these credit spreads. Take the money off the table, move on to the next trade. All right, let's go on to the opening trades that we made here today. The first one I want to go over is the butterfly that we sold in XRT. Now this is a little bit different because, well, we actually bought a butterfly, but we bought it for a credit, so some people are getting a little confused with that. So I want to go over this with you because it is a broken wing butterfly. Now we traded regular butterflies here on the website before, and we've also traded broken wings. So I want to go over these broken wings because we don't do them as often, and I want to talk about the understanding how we made this trade, how we structured this trade. Now XRT has really high implied volatility. It's the retail sector. It's been dropping, as you know. And so what we did is we came in here and we bought the 80 puts, skipped one strike or moved down to the next strike, which is the 79s. We sold 2 of the 79s and then skipped over the 78s. So we skipped over the 78s and bought 1 of the 77s. And that's where you get that broken wing side of the butterfly that we have. So let me go here, and we sold it for a credit of $28, but let me go here and show you guys visually how this looks on the profit and loss diagram. So again, down below you can see where our strikes are. We bought the 80s, sold 2 more of the 79s that we had bought, and then bought the 77s. So again, you just have to adjust it for how many butterflies you want to trade. But right here we have the profit and loss diagram, and you'll notice that right after 79, that first strike that we're double short, that's where the option diagram pivots and actually goes below the profit loss line. So this zero barrier here that you see on the left hand side, that gives us that broken wing by skipping that 60 or that 78 strike price. So by skipping that, we actually go below, and instead of making it an even butterfly like it would have been if we had bought the 78, it would have been something like that with the dotted line. We actually go below the zero barrier, and now we go negative if the stock continues to move lower. So by taking in a credit, we guarantee that if the stock trades basically anywhere 78 and higher between now and expiration, that we're going to make money. Now obviously we make the biggest chunk of our money right around 79. That's where we're short the two put options. But by taking a credit and entering this trade and making it a broken wing butterfly, we basically guarantee that if the stock trades and closes anywhere above 78 between now and expiration, we're going to make money on this trade one way or another. So let's actually go to the chart and look at it visually where we are now. Now obviously XRT had a huge down day, and we're trading this as implied volatility is at the 93rd percentile. So it's extremely high. And so right now we sold the 79s. That's where our trade is kind of centered around, is these two 79s that we sold. We bought one of the 80s, skipped over the 78s, and then bought the 77. So it's really at kind of the zero barrier. That's really about as low as we want XRT to go. We obviously want it to continue to move higher between now and March expiration. So I think this is a really good trade, even though we have a lot of movement down in XRT. It's given ourselves a lot of time to make money on this trade. I think that at least the retail sector is going to bounce back at some point, and at some point when it does, implied volatility will go down with it, which only helps our position in the long run. All right, moving on to the VIX. Now the VIX was another big one that we traded here today. We actually made 2 additional trades in the VIX today. We sold the 21-23 call spread for a 36-cent credit. Not a big credit for how wide that is, but on the VIX you can kind of adjust things. But again, the whole idea with the VIX is that it's really high right now. We're going to sell premium against it because we think at some point the VIX has to come back down, at least short term. And then what we also did is added to our current short naked option on the VIX, and that's the 17 calls. We had originally sold a call spread, and if you remember from the last video tutorial we did on Friday last week, we actually sold back the market the 19 call that we were long, made some money on that side of the trade, and we're left with a short 17 strike call. So we added to that position. That's the beauty of keeping trade size small, is that when the market gives us another opportunity to trade profitably, we add to that position by selling more premium. So what does this basically look like in the VIX? With the 17 short calls and a 220 credit, that moves our break-even point out to just about 19.5, basically where it is right now. With the 23 and 21 call spread that we also sold, we're looking at a break-even point right around $21 for the VIX based on the positions that we have. So right now we basically draw a line in the sand and say, all right, VIX, between now and February expiration, we want you to trade and close below 21. Everything that we've structured leaves this line in the sand as our basically profit loss line with all of our positions intact. And so I think that's an okay assumption, right? The VIX has had a huge move up in the last couple days. And historically, when it makes this type of move up, at least short term, it comes right back down and does not continue to go much higher. So trading at this level above 21, I feel very confident. We still have a very small position, and there's plenty of cash left over in my portfolio to add to this position if the VIX continues to move higher. I'm definitely going to play the downside of the VIX trade, and so should you. All right, moving on, we actually had a couple of just regular credit spreads that we sold. These are very usual standard strategies that we have. The XLE March credit spread was the 80.79 put spread, sold that for a $25 credit. And F is forward. We sold the 15.16 call spread for a $25 credit as well. So all of these strikes are about $1 wide, selling them for about 25% of the width of the strikes. A little bit less than what we want, but we moved out in probability so that we could give ourselves a little bit more time. And you'll notice that we're trying to trade both sides of the market. So we're trading the put side of the market and also trading the call side of the market, because if it does continue to move lower, we obviously want to have some trades on that are positioned to take advantage of a continued move lower in the market. Now, granted, a lot of the things that we've been trading have been building a very large upside position. So we do want the market to continue higher, but we're going to feather some of these call side trades in so that if the market does continue lower, at least until March, we have an opportunity to take some profit off the table. And then finally, a J&J or Johnson & Johnson 85, 82.5 put spread for 57 as a credit. So I'll just go through some of these charts here so you guys can see exactly what we're looking at as far as implied volatility. XLE was the first one. You'll notice huge move down in XLE, implied volatility at the 74th percentile. So we're just playing a nice directional assumption here on the market that at some point we're going to have some cyclicality come back into the market. XLE continues higher. Same thing with Ford. Ford has been on a huge drop. It's been down almost 8 days in a row. So we think, again, at some point that we'll have some sort of cyclicality. Ford will continue higher. The key with this trade, as with all the other credit spreads, is that implied volatility is at the 78th percentile. It's above that magic 50th percentile that we always talk about. By having implied volatility in our favor, that really helps us get on the right path to profitable trades. Same thing with Johnson & Johnson. Big move down in Johnson & Johnson. Implied volatility up at the 94th percentile. It's practically as high as it's been all year, going back almost 12 months. This is about as high as implied volatility has been in Johnson & Johnson. So by selling this strategy below the market, we take advantage of A, a drop in implied volatility, and then B, possibly a move higher in Johnson & Johnson. Same thing with Ford and Johnson & Johnson. About 8-9 days in a row here that we've had very, very negative trading. So at some point, we're going to get some people coming in here and start bottom feeding and buying up the market. Markets can't continue down at this pace forever, that's for sure, at least without making a nice little pop back up. All right, the last couple trades I want to go over are some hedge trades. So you'll notice we designated these with a hedge. And we always do that because if we always have a current position on, and this is a position that is being hedged or being used with some of the risks that we already have on the market for these positions, we'll always designate those with a hedge, and they go out that same way when we send out our SMS trading alerts. So the first one I wanted to go over is the vertical call spread that we have in Amazon. Now, just a couple days ago, we had sold a put spread in Amazon. And since we sold a put spread in Amazon that was $5 wide, only one strike, that leaves us an opportunity to then go back and sell a call spread against that put spread as long as we match the width of the strikes, which is $5, and the number of contracts. So by doing this, we have a put spread on Amazon and we have a call spread. We basically have a very synthetic iron condor on in Amazon. And so we went in and sold the 370, 375 call spread and took in a credit of $60. Now again, this isn't a huge credit for this size of a spread, but by doing this, we actually do not add any additional risk to the trade. We don't add any additional capital that's required to hold this position because we match the width of the strikes and the number of contracts. So let's go here and take a look at exactly where we're trading. So our Amazon trade, let's go actually to the trade tab so you guys can see this. And you'll notice here the two different positions that are here. As always, we have live positions on. We have the 360, 355 put spread, and now the 370, 375 call spread. Now, Amazon traded today below that 360 put spread, so it's already in the money, and it's trading below the market. So by going back in here and selling the call spread against it, we're not adding to any additional risk. And what we ideally want Amazon to do is trade back up to the 360 to 370 range. That's going to be the middle part of our iron condor. That's where we make money at expiration. But if Amazon continues to trade lower here, that's okay, because all we're doing is reducing our risk and reducing our overall potential loss by continuing to sell the call spread. So if Amazon continues to go down from here and continue to blow past our short strikes on the put side, we'll just continue to roll this call spread down and take in additional credit. And that's the name of the game. It's all about taking in additional credit without adding to your overall risk and reducing that potential loss. So if we already have a loss here booked for the put side of the trade, without adding any additional risk, we're adding credit and reducing our loss. And there's nothing else that you can do that's better than doing that as far as adjusting trades. But we're going to leave this trade on for a little bit. We've got 18 days to go in expiration for February, so hopefully we get a nice little jump here in the market. Amazon trades kind of right back around 360, 370 or so. Gives us an opportunity to take the whole strategy off, potentially at a profit here in the next couple days. Next one that we want to go over is same idea as Amazon, and that's our vertical in SPY. So we already have a put spread in SPY, and we matched it, both the number of contracts we traded and the width of the strikes. We sold the 180, 182 call spread, taking a nice credit of $60 on this one. A little bit better credit in relation to the width of the strikes here. Same thing as with Amazon is that we have no additional risk by adding this position. We'll go to SPY so you guys can see this. We're trading the March contracts here, and you'll see that the 170, 172s are right about in the money. So SPY closed today at 174.17, just above our short strike at 174. Again, you'll notice both positions are down here below, so you guys can see these are all live trades. And so what we did is we went back in here and sold the call spread, leaving ourselves enough room for the market to bounce up and still be good on this first short strike. So you'll notice on the left-hand side of the screen that our first short strike is at 180. That's right about here. So it leaves us plenty of room for the market to rally back up and hopefully settle kind of in the range of 179 to 175. That's where we want SPY to settle. Now, ideally, even if the market bounces up, all we really need is a drop in implied volatility. A drop in implied volatility at this point, which would happen if the market rallies up here, would make both of these positions decay very quickly in premium. And so again, that leaves us an opportunity to take this trade off even before expiration and lock in some profits. But by adding the call side trade to this iron condor, we didn't take in any additional risk, and all we did was add to our credit, which reduces our overall exposure, reduces our overall potential loss. So let's go to our last trade here tonight, and that is the vertical put spread in Google. Now, those of you who have been following along, we've been pretty active in Google. We had an original iron condor in Google right before earnings. Google jumped on earnings on Friday. We got rid of that put spread and sold that or bought that back at a nice profit. That left us with just a call spread in Google, the 1140, 1135, or 1145, 1140. And what we did is instead of just leaving that call spread on, now that Google has continued to trade lower and traded back out of being in the money today, we then went back in just like we are doing with Amazon and SPY and selling a put spread against that current position, therefore creating again that iron condor. So we're being very nimble with Google here, taking profits when the market gives us an opportunity to take profits on both sides. By matching the width of the strikes, which is just $5, and the number of contracts, which is just 2, we did not take in any additional risk. All we did was take in credit. So we sold the 1115, 1110 put spread, took in a nice fat credit of 151 on this trade. And so when we go to the actual chart here and you take a look at Google, I want to take a look at the Analyze tab and also the actual Trade tab. So when you take a look at the Analyze tab here of Google, you'll see our big fat iron condor that we have in Google right now, centered right around 125, 130. And that's where we want Google to trade. We want to trade up to, but not over that range. And so right now it's traded really, really down on the day. This call spread that we had at 140, 145 was deep in the money yesterday. And then today Google traded back out of the money. So Google closed at 1133. But now we have this nice fat iron condor in Google. And what used to be a max loss trade basically with this iron condor just a couple days ago, by being nimble and closing out the put side of the trade and then reselling it here today and waiting for markets to make that cyclical move, we now have an opportunity to make more than we could possibly lose on this trade. So overall on this trade, right now we could lose 384 if Google were to trade outside of this range with no adjustments. But if Google stays inside this range and implied volatility drops, we have an opportunity to make over $600 on this trade. And so that's how you got to be nimble in this market. You got to take what the market gives you, Be small with your position size. You'll notice that we're not trading any more than 2 contracts, keeping our risk exposure very low, having an opportunity to make these adjustments without having too many contracts in. But now we have an opportunity here by adjusting Google Trade along the way, even with earnings, to make twice as much as we could possibly lose on this trade. So right now, to me, that's a really good position. I'm very happy with where this Google Trade is centered. We'll obviously take it a day at a time, but again, if we get a nice move up in the market, if we get a nice move up in Google and implied volatility drops, we will quickly make some real nice money on this trade and have an opportunity to trade out of this whole strategy and lock in a nice profit overall. So again, hopefully you guys really enjoy these videos. As always, please add your comments below. I'll get to all the comments here tonight, and happy trading.